In this week's video, we'll review the latest charts and data to help us answer the question, will sticky inflation bring a recession and bear market? The stock market is closed on Monday, February 19th for Washington's birthday, and thus market participants get a rare 3-day weekend. We'll try to summarize things rapidly this week so you can enjoy your time off. Chart on your screen, S&P 500 weekly with the 30, 40, and 50-week moving averages up here. This is the 200-week moving average in red. As we have discussed in previous videos, this looks like a primary trend that became extended. The market needed to consolidate some of its gains from a longer-term perspective. It made a stand at the all-important rising 200-week moving average. Now it looks like the intermediate-term trend has reestablished itself with the 30, 40, and 50-week moving averages moving back to a full-bore bullish look. And it's noteworthy. The strong trend look has only been in place for a few months, telling us this looks like the early stages of the next leg up. Doesn't predict anything, just helps us understand the probability of good things happening relative to the probability of bad things happening in the coming weeks, months, and years. How about the secular volatility model? Does the hard data align with the message from the chart on your screen? It does. These are the scores after the close on Thursday, February 15th, 2024. These scores did not budge much, if at all, on the big down day following the disappointing CPI report on Tuesday of this week. As we noted last week, until proven otherwise, we're operating as if we're in the context of a secular bull market. If we consider the look of the S&P 500's weekly chart and the secular volatility model scores that we just covered, and we do so in an objective manner, it's difficult to draw the conclusion that the chart and the data seem particularly concerned about inflation, an imminent recession, and/or a bear market. Having said that, what can we learn by reviewing an important stock-bond ratio? History tells us if a recession were right around the corner, it is unlikely that the one-year ratio of diversified bonds, AGG, divided by the S&P 500 would look like this and be making a new 52-week low in mid-February 2024. And just as the S&P 500's chart was in risk-off mode in calendar year 2022 and righted itself in Q1 of 2023, if we look at the same ratio, the diversified basket of bonds relative to the S&P 500, AGG divided by SPY, and we put the 200-week moving average, the 30-week, the 40-week, and the 50-week on the chart, it aligns with the message covered in the opening of this week's video, the S&P 500. 2022, we switched to a risk-off look, where on a relative basis, bonds start to become more attractive relative to stocks. Q1 of 2023, the ratio goes back to a full-bore bearish look, very, very similar to the look that we had after the COVID low here in 2020 and in calendar year 2021 when the S&P 500 performed well. Similar concepts here. This is TLT, 20-plus year treasuries relative to the S&P 500, mid-February 2024. In recent months, we haven't had, and we still don't have, a risk-off or fearful look on this chart. To help us better understand that, let's look at the shift as investors' tolerance for risk began to shift from risk-on to risk-off in 2007. Same ratio, TLT divided by SPY, S&P 500 on the bottom of your screen. It's noteworthy. When the S&P started to stall in the summer of 2007, the ratio bottomed here. When the S&P 500 peaked in October of 2007, the ratio started to take off in a confident risk-off manner, and the S&P 500 went in the other direction in a risk-off manner. Moral of the story, this transition from point A to point B really doesn't look anything like February 15th, 2024. If you participated in the markets between 1982 and 2021, really all that you were familiar with was deflationary recessions and bear markets. The financial crisis period that we just reviewed was a deflationary event. And it's probably fair to say, based on the charts that we just reviewed, that the market doesn't seem particularly concerned about a repeat of that type of event. Since we're using a weight of the evidence approach, let's look at another corner of the bond market relative to stocks. Very similar situation if we look at IEF, shorter maturities, 7 to 10-year treasuries relative to the S&P 500. This really doesn't look anything like this increasing fear look back here in 2007 and 2008. If we compare lower right-hand corner of your screen, this rollover look that we have in the present day, it looks very, very similar to the rollover look here in 2012 after the major low in the S&P 500 that occurred in 2011. This shift in Q1 of 2023 also looks very, very similar to this shift here in 2016. The S&P 500 bottomed here in February of 2016. There's definitely some similarities down here. The transition in 2022, 2023, this risk-on shift here, the look that we have in the present day, similar to the risk-on transition shift after the major low in 2020 when the markets were dealing with COVID. Based on the data and the facts that we have in hand in mid-February, we're in a risk-on environment. The next logical question: if our goal is to have our account balances be significantly higher 2 to 3 years down the road, are we weighted properly? Another ratio chart on your screen. This is XLK, the technology sector, S&P 500 relative to the S&P 500. So we're looking at one sector, the tech sector, relative to all sectors in the S&P 500. Has a very similar transition. Risk off in 2022, here, back to risk on in Q1 of 2023. And if you're a client who pays attention to your allocation, right in this window here is exactly where we started to transition back to risk on. And in terms of the look of the 30-week, the 40-week, and the 50-week moving average, they've only been in confident bullish mode for a few months, all of this taking place above an upward sloping 200-week. All trends, including leadership trends, have counter-trend moves. Tech's moved a long way relative to the S&P 500, and at some point it's going to take a break. Right now, the ratio is clearly in an uptrend. If we look at the Vanguard Information Technology Fund, very, very similar to XLK. This is the relative peak here in 2021, Q1 of 2021. This is the relative peak here in Q4 of 2021. You can see we bounce around over here in 2023, and now in mid-February 2024, we're above that. So even if tech takes a break on a relative basis for a few months, has a lot of potential support down in this area here, and the relative chart here has a rising 200-week moving average below price. If we look at IXN, the global technology ETF, relative to SPY, very, very similar situation. Long-term period of indecisiveness and consolidation. Now it looks like we have a bullish breakout. Is it possible that we'll come back into this area here? Sure, it's possible. But at this moment, it looks like we have a bullish breakout, and it's holding. Take it day by day. Very similar look with IYW divided by SPY. Not as strong, but a similar improving look with the triple Qs relative to SPY. If we focus just on the technology portion of the NASDAQ 100, so the technology sector of the NASDAQ 100, similar improving look trying to reestablish the primary uptrend. With a look like this, wouldn't be shocking if we came back and tested this area down here, but that's the market's call. Very similar look with semiconductors relative to the S&P 500, the reestablishment of the leadership trend here. The last thing this ratio did was make a higher high. Again, at some point, even if the leadership trend continues, there's going to be a counter trend move where semiconductors underperform. How about foreign stocks relative to the S&P 500? Here in October of 2022, it looked like foreign stocks were trying to assert some leadership relative to the S&P 500. That leadership has waned significantly. If you're a client, when you look at this chart, you may understand some of the allocation tweaks that we've made in recent weeks and months. It doesn't mean foreign ETFs are dead in the water. The question is, from an opportunity cost perspective, right now, based on the facts that we have in front of us, the charts and the relative trends tell us there's most likely a better place for that capital. Similar situation, VEA, developed foreign markets relative to the S&P 500. The improving look here. The longer we hold below this low here, which is where we are in mid-February 2024, the less likely this looks like a bullish relative move. We had a higher high above these highs here, but now we have a lower low below this low here. Not a good look. If we looked at VEA in isolation, it looks a lot better. FEZ, the Euro Stoxx 50 large caps in Europe. You can see the improvement, the leadership look here in 2022 into mid-year 2023 and the deterioration since then. Still hanging around in here. Haven't made a low below this low, but if that were to happen, it would increase the odds the downtrend on the left side of your screen is reestablishing itself. We'll see how it unfolds. The Communications Services ETF XLC has been performing well for quite some time relative to the S&P 500. We'll see how the ratio acts in this area here. A logical way for us to examine the question on your screen is to compare present-day charts to calendar year 2022. 2022 brought something that most of us were not familiar with: an inflation-induced economic slowdown and an inflation-induced bear market. If you're concerned about inflation rearing its ugly head again in a repeat of 2022, an environment where the market was concerned about inflation and both stocks and bonds got hammered, this chart should make you feel better. Here's increasing fear here late 2021, early 2022 about inflation. This is calendar year 2022 here. Stocks are performing very poorly. Bonds are performing very poorly. Notice when that fear picks up, the ratio moves rapidly from the bottom of your screen towards the top of your screen. We don't really have anything like that since the low in October of 2023. In fact, the ratio has been moving in the exact opposite direction. Nothing overly concerning here. Agricultural commodities relative to the S&P 500. That's futures contracts tied to cocoa, live cattle, coffee, sugar, soybeans, corn, lean hogs, wheat, feeder cattle, and cotton. If the ratio on your screen starts to morph into something like this, we'll learn something about inflation expectations. That may happen very, very soon. Hasn't happened yet. Very, very similar story here. Compare the concerned about inflation look here in early 2022 to the look in the present day. Same thing with a diversified basket of commodities, physical commodities, DBC relative to SPY. It's tied to futures contracts and gasoline, crude oil, natural gas, gold, silver, wheat, sugar, soybeans, corn, copper, aluminum, and zinc. This is the risk-off look that we want to avoid over here. This is the look in mid-February. Similar situation. A defensive look here in 2022 going into about mid-year. An improving look for risk since then. Gold in isolation still looks pretty good. But from an asset allocation perspective, with a chart like this, we're in no hurry to increase our very limited exposure. Given the look of this chart here, our next chess move most likely would be to reduce exposure to gold. But the ratio of gold relative to the S&P 500 is still holding above this low here from December of 2021. How about dividend stocks relative to the S&P 500? The chart speaks for itself. DVY divided by SPY. Emerging markets continue to look weak from an investment perspective, especially on a relative basis. From a risk tolerance perspective, it's encouraging, looking back here late in 2022, that Bitcoin, the Bitcoin Trust, GBTC, relative to SPY, a much improved look over the past year or so. Midcaps have not shown a lot yet, but the only thing you can say about the look of this chart, you can make an argument that right now this higher low here relative to this low, it's possible it's similar to this setup here. We'd like to see this ratio make a sharp move like this, meaning we want to see it get out here, and better yet, above the downward sloping or flattish 200 weeks. So we'll see how it unfolds. It's possible some of that capital that's been taken out of foreign stocks could be reallocated to mid caps, small caps, or possibly even the equal weight S&P 500. But these relative charts need to show us more. As we've mentioned many times, this says a lot about the supply of homes in the United States, and it says a lot about demographics. This is home builders relative to the S&P 500. This is a consolidation box in the ratio that started in 2007. We have a breakout above that box. The ratio is above an upward sloping 200-week. The longer the breakout holds, the more meaningful it becomes. Shorter term look, similar improving look, home builders XHB relative to SPY. Full bore bullish look when we look at the ratio relative to the moving averages. Similar to the look of mid caps relative to the S&P 500. If we can get to the other side and see a convincing move, then it's possible we'll allocate some of our capital to this bucket. If we look at the same ratio with the weekly anchored volume weighted average price data, a lot of hurdles to clear here for this ratio to get into a convincing relative trend relative to the S&P 500. Here's a period of outperformance here. So we'd really like to see price get to the other side of some of these lines here. Hasn't happened yet, but as shown here, things can happen quickly on these relative charts, so we'll see how it unfolds. All trends have counter-trend moves. This is a long-term downtrend in regional banks relative to the S&P 500. This is a counter-trend move within the context of an existing downtrend. It's possible that another counter-trend move is starting or has started, but this chart still has some work to do. The odds would improve if we saw something more like this and something more like this. Here's a long-term counter-trend move in the equal weight S&P 500 relative to SPY. If we're going to increase our relatively small allocation to RSP, we want this on the right side of your screen to look more like this over here. That may happen very, very soon, but it hasn't happened yet. And you'll notice here, unlike small caps relative to the S&P 500, RSP divided by SPY has not made a higher low. This is a lower low. It is down near an area here of possible support. Similar situation with the anchored volume weighted average price lines on the weekly chart, RSP divided by SPY. It really just hasn't shown anything yet. A look like this would be more encouraging. This is growth stocks relative to the S&P 500. This is the risk-off look here in 2022, reestablishing a risk-on look. At some point, there's going to be a counter trend, or the trend will roll over. But right now, this is clearly an uptrend in the ratio of growth stocks relative to the S&P 500. The last thing it did was make a higher high. Energy relative to the S&P 500, call it a tweener chart. Weakness, intermediate term time frame, rollover look up here, but the ratio is still above a trying to turn up 200-week moving average. Relative to the research topics that we covered last week, we're 2 weeks into what is a tedious and time-consuming process. We're taking a divide and conquer approach. Kathy's been focusing on 1957, and I've been focusing on 1964. Defensive staples relative to the S&P 500. Hard, if not impossible, to make the argument that this ratio says increasing fear about a recession. So let's compare the look of the ratio in mid-February 2024 to the shift as fear was increasing in 2007. This is the exact same ratio. The S&P 500 peaks here. Notice price is above the intermediate term moving averages here very, very quickly when the market peaks. And soon thereafter, either in late October 2007 or early November, the ratio gets above the 200-week moving average in red. Contrast that with what we have on February 15th, 2024. This really doesn't look anything like Q1 of 2008. Why does that matter? Because you can see Q1 in 2008, after that, really bad things happened in the S&P 500 index. The S&P moved from 1,300 and changed down below 700. So if this chart here, the 2024 chart, does something like this, concerns would increase. We opened the video by reviewing a weekly chart of the S&P 500. We followed that with hard data, secular volatility scores. We reviewed and compared the present day to deflationary bear markets and recessions, and we reviewed and compared the present day to troubles induced by increasing fears of inflation. And from a hard data perspective, we could add our trend strength scores. They still look very, very favorable and very strong. Now, it's important to note that in this week's video, all the probabilistic statements that we've made and all of the conclusions that we've drawn have been based on the facts in front of us today. The look of the charts in mid-February 2023 and the hard data in mid-February 2023. If the charts and the data change in a material manner in the coming days and weeks, we have to be willing to reassess those probabilities and possibly draw different conclusions. And we all know the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.